That is Steve Eisman. If you follow financial history, you know his name. He is one of the few investors who accurately mapped the housing bubble and predicted the collapse of the global banking system. During the financial crisis of 2008, major institutions vanished overnight, wiping out trillions of dollars in household wealth. Eisman understood the math behind that disaster before almost anyone else. Now, he is sounding the alarm on an entirely different sector. He's warning that a massive, unmonitored pocket of the market known as private credit is carrying severe, hidden risks. For nearly 15 years, interest rates were rock bottom and borrowing was easy. An entire generation of private credit executives have mistaken this long period without a credit cycle for their own financial genius. When those loans finally blow up, the shock to the industry will be harsh. To understand why this is happening, we have to look at how the government responded to the last crash. After 2008, strict regulations successfully clamped down on traditional banks, actively restricting them from making ultra-risky corporate loans. But the corporate demand for that borrowing did not disappear. It simply moved out of the regulated light. Companies that still needed heavy financing turned to non-bank lenders. This is private credit in its simplest form, a vast shadow banking system where lending happens entirely outside the traditional regulated framework. Post-2008 regulations simply drove risky lending into the darkness. Because this debt is private, the public and the regulators are blind to its scale. We won't actually know the extent of the damage until we are standing in the middle of it. So who exactly is making these loans? Interestingly, the biggest private credit lenders are massive alternative asset managers you already know well, firms like Blackstone, Apollo, and KKR. These firms originally built their empires in private equity.
Their traditional model is straightforward: buy a company, improve its operations, and sell it later for a profit. But over the past decade, these firms realized they were leaving money on the table. When buying a company, you need debt financing. Instead of letting banks earn the interest, these firms decided to provide the debt themselves. This creates an entirely closed-loop system. In one arm of the business, private equity buys a company. In another arm, private credit lends money to itself to fund that exact same purchase. Because these loans are issued to smaller, highly leveraged companies that traditional banks won't touch, the firms charge much higher interest rates. This generates attractive yields, enticing billions of dollars from outside investors eager for a return. To raise the money they lend out, private credit firms tap into massive pools of external capital. They collect funds from insurance companies, pension funds, and increasingly everyday retail investors. But there is an unacknowledged layer beneath this growth. These firms also borrow massive sums directly from major banks. The structural irony is heavy. Traditional banks are indirectly funding the exact risky corporate loans they were expressly regulated away from touching. All the post-2008 regulations achieved was the addition of a highly profitable middleman. The foundational risk remains completely intact, but the regulatory oversight has been entirely stripped away. This brings us to the immediate, real-world threat currently tearing through this fragile structure: the SaaS Apocalypse, a brutal sell-off actively punishing the software-as-a-service industry. Private credit's exposure to this specific sector is massive. Between 2018 and 2022, private equity rushed to buy up software companies. To fund those deals, private credit supplied the debt. Today, roughly 25% of all direct lending is tied up in software businesses. The problem is that investors are realizing artificial intelligence is going to crush these platforms. Large language models threaten to simply bypass these platforms and render their traditional software useless, doing the exact same jobs much better and for a fraction of the cost. Valuations across the software sector are tanking. For the private credit funds that issued highly leveraged loans at the peak of the market, this localized software collapse acts as a lethal, direct shock to their balance sheets. The exposure is so severe that the industry is actively downplaying the numbers. Recent forensic journalism from the Wall Street Journal uncovered that private credit managers are massaging their data to avoid a panic. This chart represents a typical fund's reported portfolio. Notice how they handle the vulnerability. They deliberately misclassify tech investments into safer categories. If they fund a software business that deals with medical records, they report it strictly as healthcare, hiding the true risk. Before this investigation, major funds were reporting average software exposures of 19%.
The reality, once corrected for these accounting tricks, is closer to 25%. Because this industry operates entirely in the dark and grades its own homework, the true blast radius of an AI-driven software crash is unknowable. If these loans fail en masse, the broader market won't see it coming until the damage is already done.
Right now, a quiet panic is unfolding across Wall Street. Thousands of everyday retail investors are rushing the exits, desperately trying to pull their money out of the private credit market, only to find the doors bolted shut. These funds are managed by the industry's most dominant firms: Blackstone, Morgan Stanley, and BlackRock. Unlike stocks or bonds, which you can buy and sell in seconds, private credit loans are highly illiquid. You can't easily chop up and sell a billion-dollar corporate loan. It is a massive, rigid financial block. Historically, institutional buyers understood this trade-off: lower liquidity in exchange for higher yields. But as funds aggressively marketed to regular retail investors, they started getting creative with their data to make these frozen assets look perfectly liquid. Now, the reality of that illiquidity is breaking the machine. To prevent collapse, funds enforce strict quarterly redemption caps, honoring only 5 to 7% of withdrawal requests, trapping the rest inside. The scale of the trapped money is staggering. Investors asked for 14% of their cash back from a $33 billion Cliffwater lending fund, and only got half of it. A $26 billion BlackRock fund hit its 5% wall, leaving nearly half of the requested withdrawals unfulfilled. Discovering your money is locked inside a black box quickly erodes public trust, and as billions remain trapped, financial media is starting to ask a much darker question: is this the start of a broader systemic crash? To understand why everyone wants out right now, we have to look back at the easy money era of 2018 to 2022. During those years, private equity firms went on an absolute buying spree. Private equity targeted smaller, lower-quality software companies, paying high valuations for businesses that lacked reliable cash flow. Now, the financial environment has tightened. With interest rates resting at significantly higher levels, it has become incredibly difficult for these overvalued companies to refinance their debt or even meet their monthly loan payments. Add to that a sudden technological squeeze. The rapid advancement of artificial intelligence threatens to make the business model of these niche tech firms obsolete. Between soaring debt costs and the existential threat of AI, a massive wave of defaults in the software sector is inevitable. When these software companies default, who is holding the bag? The immediate hit lands on the private credit funds who finance these bloated acquisitions. But the actual money belongs to everyday sources: retail investors, national pension funds, and life insurance policies. And the exposure doesn't stop there. Because of a hidden mechanism: leverage. Private credit firms borrow heavily to multiply their lending power. And the primary entities providing that leverage at the top of the food chain are the major banks. This direct financial link is exactly what has the media terrified. If private credit funds take massive losses on their software loans, the banks who finance their leverage take losses too, threatening the structural integrity of the entire financial system. Widespread fears are growing that this is a repeat of the Great Financial Crisis, when hidden risks suddenly detonated across the market. In 2008, the fatal flaw in the system was that toxic mortgages were supposedly isolated off-market. But when the housing bubble burst, all of those supposedly hidden risks flowed directly back onto the bank's primary balance sheets. The mechanism that turned those bad loans into a global catastrophe was leverage, the mathematical ratio of borrowed money a bank uses compared to its actual capital. During the housing crash, major banks were operating with an average leverage of 40 to 1. For every single dollar of actual capital they held, they had borrowed and exposed $40 of risk. That ratio made the banking system a fragile house of cards. A single market loss wiped out tiny capital reserves. But today's private credit market operates under different rules. Business development company leverage is strictly regulated. They operate at just 2 to 1. Sober, the private credit market still faces a painful correction. Low-quality software companies will fail, and the retail investors trapped at the exits will absorb real financial losses. Because the institutional leverage is a tiny fraction of what we saw in the housing crash, the damage is contained. This is a severe, localized crunch, but the broader banking firewall will hold.